Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And if you ever wanted to sell an options seminar or get somebody excited about options, one of the easiest and most quote-unquote sexy plays that people like to do is the long straddle. All right, and a long straddle basically means that I'm going to buy this option contract, and I really think the market's going to move. I either think it's going to move way up or I think it's going to move way down. And no matter what happens, as long as it makes that big move, I can be profitable. So you know that if you look at a standard distribution, or one of the biggest assumptions of the Black-Scholes pricing model, is that it's very hard to pick direction. Notice here, half of the occurrences are on this side of the equation, and the other half are on this side of the equation. That implies that if I buy a stock today, I don't care if the Bollinger Band runs into the moving average and hits the Fibonacci number. Bottom line is there's about a 50-50 chance if the stock's going to go up or go down over that time period. All right? So you know that people are having a tough time picking long straddles. So here's a question for you. If I were going to do, and you can answer some of the questions, I can actually see the answers, and I'll just kind of play along, but this will just be a simple little reindeer game that we could play in. And if I look at this, and I was thinking about doing a straddle. You're the market maker down on the trading floor. I just walked into the trading crowd, and I said, give me the market on the 100 straddle. All right? And you will just pretend that you know I'm buying, and you say, give me the market on the 100 straddle. What would the 100 straddle be trading for? If I knew this information, what would I price my 100 straddle at? All right. Type it into your Q&A box, whatever you think the answer would be. Kind of like to see some people's opinion. All right, and just think about it for a second. If I know this information, can I use this in my option trading? Do market makers use this when they trade? And the first answer, and the answer is, I'm getting a lot of people saying yes, they do use it, and that's very true. And George came up and said, George was one of the first people to answer with a right answer, and he said that it would be worth 20. And yeah, that kind of makes sense, because if you wanted to buy this, I would sell you the put for 10, and I would sell you the call for 10. That means the total cost of the trade would be 20. And if you look at that, that implies that most of the time, if you buy a long straddle, the market doesn't make that move. Okay, now, the actual math I'm not going to get into too much, but most of the time long straddles will trade for about 80% of a 1 standard deviation move. So it will normally trade for about 80% of a 1 standard deviation move. So in this case, it would trade for around 16. I didn't expect you to say that, and I would assume that a lot of people would say 20. And if you say 20, that means that you're understanding the concept. That if you do long straddles a lot, this is why you hear a lot of people say, if you do a long straddle, 7 out of 10 times you usually don't make money. And yes, most people don't ride them to expiration, but bottom line is the move is going to be significant enough that a lot of times it's not going to make that move, and that's what makes it tricky with long straddles. So if you're a long straddle trader, what I always suggest doing more so is you got to be prepared to let your winners run, and when you take your loss, know that it's going to be a lot of the times you're going to take more losses than wins. So you got to keep your losses small, and you got to let your winners run and make them large, because the biggest thing about the long straddle is you have to assume it's going to make more than a 1 standard deviation move, and you hope that once it makes that move, it's going to just keep right on going. That the news or the reason why you did that is out there. Okay, I'm digressing a little bit, but bottom line is if I look at this now, you can actually figure this math out for a different time period. For example, if we go to the next slide. Next. Okay, there it goes. If I go to the next slide, I can actually see that we actually have a table. This is different volatilities for different time periods. And this is very, very, very quick and dirty math. Is everybody out there? I hope you guys are all sitting down. Are you guys ready for this? I'm going to give you a big secret of the options marketplace. Right? Here we go. Options move at the square root of time. All right. Nobody has to go and make a phone call or anything nutty like that, I hope. Right? No, it's kind of a boring concept, but if you ever look at a Black-Scholes pricing model, you'll actually see a square root sign over the letter T. And that's what it implies. So it makes math simple if it's a really easy situation in that you got 360 days in a year, 360. You can only trade 30, 60, 90-day option contracts. If we do that, we can actually figure out for different time periods what the volatility would be. So I'm just going to highlight the 20 line here. And if you looked at the number of 90-day periods in a year, in a 360-day year, that would be 4. What is 20 divided by the square root of 4? That means 10. It means over 90 days the stock's expected to move around 10%. Now if I look at a 30-day period, it's going to be a little bit less, right? It's not expected to move as much in 30 days as it may do in 90 days. So if I look at that, how many 90-day or 30-day periods are there in a year? Take that, there are 12 of them. Take 20%, divide by the square root of 12, and you come up with a 5% move over those 30-day periods. Now, granted, this is really, really quick and dirty math, but once again, I just want you to kind of understand the concept. Now, if this is a 29-day period, it doesn't work. If it's a 28-day period, it doesn't work. This quick and dirty math is only for those different time periods. So you see, over time, this is the way volatility moves. It gets wider and wider. Stock's at 100 as we move and progress through time. And bottom line is the marketplace is implying that the stock will stay within these ranges about 68% of the time. All right, so how are we going to use this information? Well, today we're going to get into butterfly spreads. In about the next half hour, I'm going to go through 2 or 3 really simple butterflies. And I'm hoping that we can finish this all up at about 5:30. But if I look at this trade and I'm looking at butterfly examples, first of all, I want to talk about volatility in general. Okay, so how is vol in the currencies going? And if I go to TradeKing.com, we actually have some volatility graphs, and you can see that across the board, volatility has been fairly high. But it's kind of interesting. This is the ISE FX Australian dollar. This is a 1-year graph, and we can actually look at the last 3 months if we would like. Let's pull that up. And we see here's the historical volatility has actually been higher than the implied. All right. So the implied on this has actually been wrong. This implies to me that you were better off if you were buying option contracts than selling them if hindsight's 20/20. All right, because the market actually moved more than what the marketplace was implying. And we see that if we look at the 1-year highs on a lot of these, look at this, we're still way up in the high end. Okay, so I want to keep that abreast of my trading. So let's pull up the other one. Let's look at BPX. This is the British pound. See volatility still on the way high end here compared to the year average. Let's go CDD, which is the Canadian dollar. ISE Canadian dollar, and it's still its implied volatility went high, but it's creeping back up towards its highs again. All right, and today it was actually very volatile across the board. So you kind of see the theme all across the board here, and I'll pull up one more. Let's look at the euro, EUI. All right, implied volatility, if we look at a 30-day versus a 30-day weighted option contract, much like the VIX index, this is just a mean index, an average of the option contracts to come up with a 30-day average compared to the 30-day historical. We see that this is also trading near its high end for the year across the board.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.